Welcome to the second panel of OMFIF's morning on the outlook for European sovereign borrowing 2022. Thanks to all the previous participants, panelists, and of course to Mr. Koopman and David for their excellent start, and Frank, of course, who opened the proceedings this morning. So on this panel, we have three sovereign borrowers. Our friends from Moody's and Bryn Jones from Rathbones representing the buy side. I'll just introduce everybody very quickly. We have from the Kingdom of the Netherlands, Elvira Eurlings, who is the director of the Dutch Treasury State Agency in the Dutch Ministry of Finance. Davide Iacovoni is Director General of Public Debt Management at the Italian Treasury. Dimitris Tsakonas is the Director General of the PDMA, the Public Debt Management Agency in Greece. Bryn, as I've already mentioned, Head of Fixed Income at Rathbones. And Sarah Carlson is SVP in the Sovereign Risk Group at Moody's, and she covers the Netherlands among the countries represented here, and also Italy, I think. Anyway, we'll come to all of that. So, welcome everybody. We've got similar kind of format to the last panel, if you were in it, about an hour's conversation among the six of us, and then some time for questions from the audience. I may turn to questions from the audience a bit earlier. So anyway, put them in. The audience questions come up on a screen over here, which has writing about the size of the newspapers. So my old eyes, we will see them, I'm sure, when they come. So, ladies and gentlemen, Davide, I can sort of see your right ear, but not much more of the rest of you. Ah, there you are. Lovely. Thank you very much. So, European sovereigns and everybody else in the world enters 2022, a 2022 that's rather different from 2021. We've got vaccination, but we've also got inflation. We have recovery and resilience. They're part of the rallying cry of the European Union. Let's just take the temperature of the three countries here, the sovereigns. I just want to ask more generally, not at the moment about your specific borrowing plans or what recent market operations, but just, as I say, to kind of take your temperature. How much more comfortable are you feeling now than you were feeling a year ago? Dimitris, why don't I start with you?
Excellent. Thank you first of all, it's a great honor for me to be with you in this panel. And it's an excellent question. As perhaps you could mention, it's a challenging one. Indeed, very hot markets, to be honest. We just issued the 10-year bond recently. Yesterday, to be honest. And
we'll talk about that, yes.
Yeah. And I need to say, and I need to stress that for whoever feels dizzy, that suddenly just realized that the Earth turns around, all day, I need to inform that everybody that this happens the last 4.5 billion years. So that means that we are going to see higher interest rate environment, perhaps lower, not compared to today's level or to a years ago. But volatility is the key element of capital markets. So we are prepared, if you allow me to say, and I'm referring to the PDMA and to the Greek, to the Hellenic Republic, with the solidarity provided by European institutions, Eurozone partners, etc. We are prepared to face all these risks that may be arising in the future. Since we have a very, very favorable structure of debt with 20.5 years weighted average maturity and in fixed rate close to 99.5%. So we are prepared. Challenging times. I need to stress that we're going to face all the difficulties that may be arising.
Okay, good. Well, we can always rely on a Greek speaker to give us a long and historical perspective. So after the wisdom of ancient Greece, Davide, let's turn to the wisdom of ancient Rome. What's your sort of, 1 minute view of how this year is looking compared to the, tricky position we all felt we were in last year?
But first of all, thank you for having invited myself, Italy, to this distinguished conference. So really appreciate that. It's quite a difficult question. You won't imagine this, but it's exactly in this time. The situation is really twofolded, and I will come back on the points raised by Dimitris, which I completely agree with. On the one side, the macro picture, I think in Italy, but in most of European countries, it's of course it's much better if I have to compare the beginning of 2021. In Italy, we probably gonna close 2021 with a growth in real terms above 6%, which is something absolutely exceptional for Italy. Of course, we are coming from a dramatic 2020 here, so there's clearly a rebound component there. But honestly, we have performed much better than everybody could expect just only 3 months ago. This is bringing also an improvement in the public finance picture. Deficit and debt will come significantly down, even with respect to the levels we could be able to estimate just in September. So we're going to have several points of decrease, for example, debt GDP ratio in 2021 if compared to 2020. So the latest data regarding the economy, for example, the industrial production that came in November, probably still in slightly before the dramatic rise in energy prices and all the things that are going on now, but it was already unfolding at that point. And despite that, the manufacturing sector, industrial production, was performing very well. Of course, we don't know exactly now what's going to happen in the next few months. The situation maybe can be a little bit worse than we initially planned, but we have to see. There's these feedback coming from 2021 that probably will be prolonged also during this year. So the picture is rather good for us. But on the other side, as Dimitri was saying, no doubt that volatility has risen. There's much more tensions. We have been placing successfully a new 30-year bond at the very beginning of the year. And also we carried out some auctions. They all went well, but no doubt that the dynamic of the market, the underlying market, has changed. And not so much because interest rates are rising, but as Dimitri was saying, because really volatility is rising. I can't forget why we were executing our 30-year bond. The volatility when we were executing the deal was really high, and we had to work hard to get it priced in as much fair possible way. So that's the kind of picture right now. We'll see how things will evolve. But it's really, black and white, if you want.
Well, the final comment on the previous panel, I don't know if you all heard it, but from Bryn Manguiro at Barings, he said, we're very optimistic about Europe. He also said it's all about growth. So he saw little risk because there was a great deal of growth. So debt sustainability is not a question. Elvira, do you share the bullish outlook of your southern neighbors?
Yes, I do. I agree with the picture that has been sketched by Davide and Dimitris. So it's a mixed picture. So we, like in many other countries, we still have the pandemic amongst us. We see a pickup in infections here in the country. We still have some sectors being closed. The fact that we talk about inflation also in the previous panel, it's now on our agenda. It hasn't been for quite a while, so that's also something, of course, to watch. On the other hand, 2020 was a dramatic year in the country. We saw a contraction of GDP, which we haven't seen before. In 2021, we saw an equal pickup. So where we saw a contraction of 3.8, we saw an economic growth of 3.9% last year. Not the numbers that Davide have been mentioning, but we saw a strong rebound. We expect the same number for this year, a broad-based economic growth underpinned by exports, increased demand from abroad, investments, government and household consumption. We have a new government in office as of last week, presenting ambitious government plans in terms of climate, infrastructure, that will have an impact on debt levels, but they will still be below 60% of GDP. At least that's what we hope. So yeah, mixed picture. We see obviously volatility. We need to time our options well. And at the same time, we are confident in the outlook in terms of the economy.
Very good. Bryn, is everything in the garden rosy from where you're sitting? We've had lots of vaccinations, but we've also got inflation. And as Isla said in the last panel, who's heard that word for a long time? But now you can't open your eyes without seeing it written down somewhere. What's your headline view?
Well, I'm always on panels to create conflict. So
exactly, that's why I asked you.
Well, one of the things that surprised me about Dimitris' comments that interest rates continue to rise and go up and down over billions of years is that also we have to remember that when interest rates go up, quite often you get quite large defaults. And obviously, being from Greece and obviously with an Italian member on here with huge amounts of debt, rising interest rates, can create default cycles, and we mustn't take our eyes off that. And I'm going to go back through a little bit of history. In the 1970s, the UK wasn't very, 60s and 70s, the UK wasn't very productive. We had a lot of unions and, the kind of left of centre, and we had a lot of like kind of zombie companies. And it was only when Thatcher came in and basically created destructive capitalism to get rid of these unproductive companies that the UK really, really benefited from that in the 90s. And I think we've gone back to sort of this social capitalism. We've had interest rate cuts since 2008, and everyone can work on return on equity of 1%. It doesn't really matter. You can borrow at zero, and you don't have to be that productive. And companies have not defaulted. This is the lowest year of defaults that we've seen in history in the high yield market. And so what concerns me is obviously higher inflation, higher rates, is that we shouldn't be too sanguine about a possible default cycle. We've seen energy companies, we saw EDF this week come out and have their price caps. There's already pretty much nationalized business. Could we see the next default cycle in the energy business as rates go up and at the same time as their margins get squeezed by price caps? I don't know. So I'm kind of been looking at this philosophically. I've benefited in my career over the last 13 years from rates coming down and basically central banks buying credit. What happens at the reverse of that? And that's what concerns me a little bit. We can't be too sanguine about where's the next peak in rates.
Well, we're going to ask specifically if that reverse, that telegraphed reverse of central bank purchases, at least in respect to the ECB, is actually going to happen and what impact it will have. But before we do that, Sarah, credit worthiness and risk of default that Bryn has just raised, those are your everyday food and drink. I'd be interested to hear your comments in reaction to what Bryn said, but just more generally also your kind of headline outlook for the year. And then we'll turn to each of the borrowers and ask them specifically for the numbers of what they've already released them all, but just to confirm to us what all the numbers are. So Sarah, welcome, and please take the mic.
Thanks very much. And I mean, as far as the macro outlook for the year goes, we share a fairly bullish outlook on growth. There are uncertainties, of course, around inflation, around supply chain issues. But as far as economic growth goes, we have a pretty constructive outlook for this year. I think something in this touches on the subject that Bryn brought up. I mean, one of the most frequently asked questions I get from investors is, do debt burdens matter anymore? And I think our answer is absolutely yes, they do. And that goes back to some of these themes about debt affordability. If you look at the advanced market world versus the emerging market world, trends in debt affordability since the beginning of the pandemic have been very, very different. Debt affordability, so we measure it looking at the ratio of interest payments to government revenues. In emerging markets, that's been getting worse in advanced economies, even though they are almost all more indebted now than they were before the pandemic. Debt affordability has actually been improving. So what does that mean in a world where debt may become more expensive? We're not expecting the ECB to raise rates. through 2023, but in a world where the direction of travel for interest rates at some point is likely to be higher. Actually, it's important to look at what debt managers have been doing with their debt management strategy. And there you can see we have much longer maturity structures of the total debt stock. And so when we published in November a stress test of what would debt affordability look like if we were to see interest rates 150 basis points higher. And actually, debt affordability would still be better in 2025 than it was in 2017. So cheap rates have been locked in for longer, and that means that governments certainly do have a fair bit of shock absorption capacity when it comes to a higher interest rate environment.
Okay, Davide, I'm going to turn to you as the first of our sovereigns. You actually mentioned in your opening remarks that interest rates were rising. I don't know if you know something from Frankfurt that we don't know, but perhaps we were talking about a different currency, which also we shall come on to. Other currencies are available, ladies and gentlemen. But Davide, Italy's plans for the year, you've announced a borrowing program of 330 billion, if I'm not wrong. Could you just sketch the shape of that, what it looks like?
Yeah, sure. Well, the numbers are slightly lower than you mentioned, but maybe some more detail is needed. So we are planning to issue overall in line with what we issued in 2021, which stays in the area of 320 billion euros of bonds or medium long-term funding, but I want to be clear on that. This also includes the NGU funding tranche that should hover in the area of 20 billion euros for 2022, so this year. As you know, Italy is fully on track when it comes to targets and milestone of the NGU plan. So we completed that in 2021, and so we already made a request for these funding. And so overall, we are expecting this around 20 billion euros for 2022, so for the current year, which means that our plan on bonds, on our bonds, will stay in the area of 300 billion euros, more or less. Of course, we will much of the funding will keep on being on fixed rate conventional bonds. As you know, we cover plenty of maturities from 3 years or even shorter, actually, from 18 months up to 30 and then 50 years. But we have also our linker program, and we are, of course, there's a lot of reflection now on how to assess our policy in this new inflationary environment. Let's call it in this way, but I don't know it's the proper way.
Well, I was specifically going to ask you what proportion is planned to be in linkers. And that's a little prologue to a conversation we're going to have a bit later on. But what is the proportion of linkers in that?
Yeah, I mean, we are planning to stay for when it comes to our European inflation-linked bonds in the area of probably 6-7% of these total funding. But then you have to add that we have our retail, one of our retail products is also linked to inflation, but it's the domestic inflation. So overall, then we can reach around 8 or 7 or 8% of our funding. Normally, we are keeping with this stock in the area of 10% in terms of stock of debt. Finally, let me just add the fact that we are one of the few issuers in Europe having a stable program of floaters, which already last year came to be very much in appeal by market participants. And we think it also this year in an environment of higher rates or expectation of higher rates, these products have been very much in demand. Normally, they're very much bought by domestic investors, but last year we have seen a growing interest from foreign investors, especially coming from continental Europe. So we think this trend will continue. So this will be another important source for us to diversify with respect to standard fixed rate bonds.
Very good. Thanks, Davide. Dimitris, I haven't actually seen the figures that you've announced, but tell us what they are and tell us the shape of the funding plans for 22.
Thank you very much. Once again, we have the opposite problem, i.e., due to the favorable structure of our debt, as I mentioned before, with the intervention of Eurozone partners and the help provided by them, solidarity, etc. Now we have gross financing needs versus GDP in weighted average terms for a long period of time, i.e. approximately 40 years, on an annual basis, close to 10% of our GDP. Based on this, the funding strategy for 2022 has to do with an amount, i.e. access to the capital markets, 12 billion, and to be honest, having in place an outstanding amount of cash reserves that as we speak right now, stands at the levels of more than 40 billion, i.e. close to 25% of GDP. To be honest, we want to have access to the capital markets, not just to cover the funding needs of this year or of the next year, since all these needs are already covered, but in order to keep our continuous presence in the capital market, continuing the dialogue with investors, because this is, if you allow me to say, the way being back to normality, gradually, steadily, at a certain point of time. If I need to define what back to normality means, obviously it's the investment grade status, which would be a turning point, if you allow me to say, as far as our recent history is concerned.
Okay.
In any case, we want to issue, and in this context, the yesterday's deal should be considered. We want to issue, once again, benchmark liquid in the context of, in a sense of a Eurozone benchmark, liquid benchmark issue, GGBs. We did it with the 10-year. Most probably we're going to raise at a later stage the issued amount just to provide additional liquidity. To be honest, we need to be present to the capital markets because due to the lack of needs, we have the opposite problem. Again, pandemic for us was a unique opportunity to have access to capital markets, to rebuild sooner rather than later the yield curve, to extend the maturity. Now we have across the yield curve, across the maturity spectrum of the yield curve, a lot of maturity points with sufficient liquidity compared to 2 or 3 years ago. So in a sense, you know, the side effect of pandemic, as far as Greece is concerned, was extremely positive. Now we need to keep going, just trying to keep our consistency. A 10-year, perhaps we can play with the maturities. It depends, everything depends on markets, market conditions and investors' appetite. We can go for shorter or even longer maturities. Again, it depends on market conditions. So we are pretty flexible, both in terms of the maturities and in terms of the size, if you allow me to say.
Yeah, well, we'll talk some more about how the bid shaped up for yesterday's deal, because there was an interesting technical point made in the earlier panel on that, but I don't want to touch that now. But when you're talking about having had a good pandemic from a funding point of view, that of course is because the ratings criteria were waived for the PEP, the pandemic, specifically pandemic-related purchasing scheme, because of course Greece was not eligible under the APP, under the asset purchasing scheme. So that was what gave rise to the situation you've just described.
Indeed.
Yeah.
Indeed.
Okay.
We need to be honest. We need to be honest. Yes. It provided us an opportunity to issue like a normal, let's say, Eurozone sovereign issuer, and it gave us the opportunity, as I mentioned before, to rebuild a liquid, brand new yield curve, which was the case 2 years ago, if you allow me to say, given the fact the very low, let's say, in percentage terms, gross financing needs, annual gross financing needs for a long period of time, almost 50% compared to the weighted average of other Eurozone peers.
Yeah. Okay. Good. But thanks for that clarification on the PEP. Elvira, I think I have an exact number for you, 74.5 billion, because we talked about it the other day. But just tell us a little bit about the shape of that. 5 billion of it is green in one way or another, and that's going to be our next topic. So please give us your sketch of the Kingdom of the Netherlands.
Thank you. Well, it's funny that, you know, on Dimitris' point, I sort of recognize it. When I came in office 4 years ago, our funding need was very low, around 43, 45 billion annually. And if you then at that time want to, for example, introduce a new product, that's quite a puzzle because it cannibalizes in all kinds of existing products you have. So also having a limited funding need is a challenge. You become a small issuer, you want to also listen to the market and the needs of new products, but to fit it in relatively lower amount is also a challenge. So in that way, it's almost shameful to say, but the pandemic from a debt management perspective has allowed us to increase liquidity, think a bit more relaxed about new products, also being able to inject liquidity in a curve where we saw it fit. So in that way, from a debt management perspective, it can indeed give some opportunities. So where we were looking at a 40, 45 billion funding need that jumped up immediately in 2020, 2021, almost more than double. We financed 90 billion euros last year. And we're looking at a bit lower amount, Christopher, that you were mentioning just now, because we have some updated numbers out. So they're around 73 billion for the coming year. Still a significant amount, historically also for the Dutch, almost more than double that we've seen before. Our standards issuance principles are that we want to ensure liquidity across the curve. So we will have a call on the capital market and money market that we try to balance. We have an underlying objective, I think it has been mentioned before also in previous panels, and also by Sarah, to lengthen the average maturity of a portfolio. In 2012, we were looking at an average maturity between 3 or 4 years. Now we're looking at 8. So we have been really significantly extending the average maturity of a portfolio. And that's also why we will more than 65% of this call will be on the capital market. So 45 billion out of the 73 billion we will raise on the capital market, remaining on the money market. We will be issuing a new 10-year benchmark bond next month. We've published the press release yesterday. We will also issue a new 30-year because that fits nicely with that objective of extending the average maturity. And indeed, we will talk about it later. Part of that 45 billion, 5 billion will be on reopening our existing green bonds. And we hope to issue more green bonds going forward. But we had to publish our story before the new government came in office. So we have to wait a bit for their plans.
Sure. Christian from the Finanzagentur just mentioned gently that with the longer end, there might be a little bit of investor concern from an inflationary point of view. Brief comment from you on that, just specifically as you mentioned a 30-year impending.
Yeah, we still see significant demand from the market. It fits with the objective that we have to extend the average maturity of a portfolio. It's not a significant amount that we will issue. We will issue around 5 billion in the 30-year point. We think there's sufficient demand for it, and we can sustain it also going forward. Okay,
well, we'll ask our investor in the moment if he's going to buy it. But Sarah, they've sketched borrowing plans, funding needs, borrowing plans, not all of it needed, perhaps in a strict sense. You're comfortable with it all from a creditworthiness and ratings point of view? And subsidiary question, when are you going to return Dimitris normality for which he yearns? Despite the fact that the virus is always called Delta and Omicron and things like that, it doesn't come from Greece, it comes from somewhere further east. Are you going to be upgrading Greece? That's a terrible question to ask you, but comment on what they've all said and do give us a quick note on Dimitris's ambition.
A quick note on the Greek rating. I mean, we rate Greece BA3 stable, and the kinds of things that we'll be looking at with regard to not just the Greek rating, but actually this is a common theme that you see across a lot of countries in the Euro area, common themes about increasing growth potential, reductions in debt, as well as for some countries on a case-by-case basis. It is relevant in the case of Greece, issues in the banking sector. But that brings me neatly on. Davide beat me to the punch in being the first one to mention Next Generation EU. But I think that's actually something that's quite an important consideration if we think about rating trajectories, because again, if you look across our credit opinions that we've written for EU countries, you see these common themes about need to increase growth potential, need to erode debt burdens, and that upward rating movement is actually dependent on those kinds of changes. I mean, we see Next Gen EU as being something. I mean, we use this language in our Euro area outlook that we published at the end of last year, a once in a generation opportunity for countries. And there are a couple of reasons for that. One is just the sheer size of funds that are available. If you take the MFF funds plus the Next Gen EU funds, this is the biggest stimulus package that Europe has ever brought out. But there's also something important in the construction of it, which is it's not just about cash, it's also disbursement of those funds is contingent in many cases on structural economic reforms. And many of these reforms are things that international observers have been watching for many years as being things that could materially improve growth prospects.
Will countries be held to the fulfillment of those contingencies, though, by markets or indeed by other mechanisms?
That's one of the sources of uncertainty, and that's one of the things that's about to come to talk about is this is a once-in-a-generation opportunity, and so the question that we often ask is how well will countries take advantage of this opportunity? Some of them have fairly mixed track records in terms of fund absorption. It's just a lot of money also to be able to absorb. There are political complexities with regard to legislating and implementing some of these reforms. And then there's also questions about whether or not countries get held to this sort of conditionality for fund disbursement. So we're not blind to those big questions. At the same time, I think we all have to acknowledge that this is an important opportunity and something which that changes the incentive structure for doing some things that have proven in some cases over a number of decades to be very difficult to execute on.
Do you remember some years ago the phrase moral hazard became the daily currency of financial markets? Maybe we need to get back to a little bit of that. Now we're going to come on to specifically the NGEU and how that sort of merges into sovereign borrowings, and we're going to come on next topic I just want to talk conceptually about green, because it's in the title of our panel. But before I do that, Bryn, I don't have to ask you a question. I'm sure you've heard what four people have said. Pick your reaction.
Yeah, I guess for me, it's all about the likely demand supply. All economics is demand and supply. And what's interesting is that we've got an increase in supply of the EU as well as the supranationals. So traditional investors that would buy supranationals now might be looking at the kind of EU bonds as well. We've also got someone else coming into the space, which are governments, which are issuing, which comes on to the next question, which is issuing more social, sustainable green bonds as well, which is kind of where partly you could argue supranationals have been. I mean, it's not pure play because some of them fund oil pipelines and all the rest of it. But what I'm saying is that, there seems to be an increase in supply. Now, whether with central banks stepping back, we've got to watch that demand and supply dynamic. There's still going to be huge demand from pension funds and investors and whatnot. So, but it's just how does that balance out? And also as yields rise, do asset allocators start to decrease their allocation to fixed income in the initial part as they're worried about the negative potential returns? But going on to the default question is, historically, supranationals and governments tend to be the kind of safer place to invest. So in a rising interest rate environment, suddenly investors might switch out of their credit and take the higher yields they can get from the supranationals. So whilst I don't have the answers, that's the thing that we've got to watch for over the next couple of years, I think, as we trend back to a kind of normalish, if you can call it that, economic system.
Okay, good. Thanks, Bryn. Elvira, I'm going to turn to you first, partly because we had a sort of slight prologue to this conversation when just the two of us were talking the other day. I mean, the theme of every bond discussion for a long time now is thematic bonds. We say green. I say green. Of course, we're talking about green bonds, social bonds, blue bonds for the oceans, white bonds for pharmaceuticals, gender bonds, bonds of every possible description. I just want to look for a moment or two at the general concept. Is it clear what good these things do?
Yeah, I think you're asking a big fan here. So absolutely, I would say.
So we asked the evangelists to justify the gospel. Exactly.
I know, Davide knows. I'm always preaching about this, and I'm very happy to see also Davide now also joining the green bond space. From a personal anecdote, when we went on a roadshow, when we first had our inaugural bonds issuance, our green issuance back in 2019, I've seen a lot of investors and fund managers, and one of the a few fund managers told me that only when the governments became active in the green bond space, the fund managers went out raising money for impact funds because they could diversify their portfolios by having risk-free, solid risk assets from governments in a portfolio. They could also raise money, diversify, and support other kinds of climate investments. So I think by the end of the day, being active as a government in the green bond space helps catalyze and mobilize more money for climate investments. And I think that's the ultimate higher goal. And you could, of course, say a lot about, do you need green bonds? Because otherwise these climate investments also gets financed. Sure. What's the additionality in that regard? Maybe not so much. But I truly believe that the governments have a role to play here and bring to the market this type of asset class that allows fund managers and other investors to broaden the possibility and finance options for climate needed investments. So I'm convinced it brings good. It also has increased transparency about how the money is being spent. From my own experience in the Netherlands, we came up with much more impact indicators than what we reported on these investments before. We never, for example, were transparent on the impact of investments on railways, for example. To what extent does it avoid CO2 emissions? We never reported in that way to Parliament. Now we do through our impact reports. So yes, I'm a believer. And I see that it brings additional value to the green bond space, to the scale, to the transparency and impact reporting. So I would say, yes, it definitely brings good.
Okay, but only 6.something% of your borrowing plans for this year are in GSS. You can answer that in 10 seconds.
It's 5 billion out of 45. And you may say, well, that's a small amount, but we did commit to 5 billion, even if we had no government in office. So we said, anyhow, we will raise up until 16 billion now in green bonds. It's a significant amount outstanding.
Sure.
And the new government has announced up to 35 billion more in climate investments for the next few years. So I'm sure much more green bonds will come out.
Okay. Bryn, I'm going to come straight back to you, not least because Elvira mentioned kind of buy-side push. Investors want labeled bonds, green bonds, GSS bonds. I mean, do you have a single asset owner who would dare say, no, I'm not terribly bothered about that, just make me some money? Do you have mandates that do not include GSS?
We do have pure credit portfolios. So our unit trusts are, one of them is one of the biggest in the UK now. It's 2.8 billion with an offshore of 250 million, so over 3 billion. that is a credit fund, non-benchmarked, highly active, truly active fund. So if we don't like a sector, we won't own it. And currently we have very little supranationals in there because we've been buying all the beta. But as I said earlier, if the cycle changes, we're more likely we can buy supranationals and government debt. are more likely to load up on that if we are concerned to defend our investors' returns. There isn't specifically portfolios that exclude it, but what's more interesting is, I think, the whole green sustainability issue is that what we're seeing in regulation, we've seen it in Europe. Europe's ahead of the UK. Europe's got SFDR, EU taxonomy, and for our SICAV, we have to go through a whole load of regulatory hoops to prove its sustainability. In the UK, there isn't necessarily any prescriptive regulation currently from the FCA. Although, having said that, being a member of the Investment Association, we know there are discussions and consultations going on where we're going to start to see this coming down the pipe. And so on that basis, investors are going to be forced into buying green sustainable bonds in order to prove the sustainability. And not only that, on a discretionary level now, there is also a requirement now for them to overlay sustainable and green credentials as well. What I do think is a problem at the moment is that it's not apples and apples. We're quite the scope 1, scope 2, scope 3. It's okay doing scope 1 and scope 2. As soon as you get into scope 3, you have to look at things like Sustainalytics analysis of our portfolio. They only cover 61% of our portfolio in terms of understanding the carbon. So until regulation forces supranationals and governments and corporations into producing a standardization of reporting, almost like US GAAP in accounting, but a standardization of accounting for the climate sustainability, that investors like myself can then, analyze apples versus apples and say, well, actually, the EIB or the IRBD or whoever are better, and therefore we're going to invest in that on that basis. So there's a few things going on there, and I think it's not necessarily prohibiting supranationals. It's actually what will happen is the businesses that are doing things badly and not doing it will not get the funding, and that's basically what regulation is trying to do, right? It's trying to force everyone to behave in a better manner, in a more environmentally friendly and more social way. And if you don't do that, then you won't get the funding, and your cost of capital goes up.
Thanks, Bryn. Sarah, do you foresee a time when we're no longer talking about labels because everything essentially has the same label? And as Bryn says, if you don't have the kind of if you don't have good on your side, you won't get funded anyway, so you won't even bother to try. Do you foresee that time? And second question to you before I turn to Italy and Greece. Unified taxonomies, a US GAAP for sustainability. Is that something that is realistically envisageable?
I mean, ultimately, the approach we've taken on the rating side at Moody's is we've got a taxonomy that we apply. I mean, part of the reason for some of the inconsistencies is that you have this incredibly diverse group of stakeholders, each of whom have their own objectives, and taxonomies that they choose sometimes are in line with that. The way in which we structure our thinking about, we call them credit impact scores. So this is the impact of E, S, and G on credit risk, is we have formulated a taxonomy that we think is pretty comprehensive, where we need to distinguish between public and private sector. We do that particularly with social and governance risks, and to be transparent to the market about where we see the particular credit issues emanating from environmental, social, and governance risks for a range of entities. We've done this for all sovereigns that we rate, all sub-sovereigns that we rate, all of the supras that we rate, as well as significant parts of financial institutions and non-financial corporates. So, I mean, that's the perspective, like I say, on the rating side that we're approaching this with, and we're rolling out those credit impact scores across all of the rating groups one by one. And again, using similar language, similar to as the same taxonomy, like I say, with some differentiation between public and private sectors, no matter which rating group you're looking at.
Okay, great. Davide, thanks, Sarah. Davide, kind of same question to you, but a specific question as well. I was listening yesterday to an off-the-record presentation by a Eurozone central banker who was talking about a proposal that had come from Italy to strip green and indeed digitalisation, which we will come to, I promise, to strip green and digitalisation bonds out of the debt when looking at debt sustainability in the old-fashioned way. So I'd be interested if you have a specific comment on that, and if it is a potentially a serious proposal. But more generally first, if you don't mind, Davide, thank you.
Well, let me first say something regarding this issue of having many different type of bonds depending on the kind of public expenditure they're going to finance. As Elvira was reminding, thank you, Elvira. Yes, we joined the group of Green Bond, and I have to say I would match every word Elvira was saying regarding the importance of this bond and how much we believe in this project, even if I have to say it's pretty burdensome, both in terms of pre-issuance and post-issuance activity. But it's true. I mean, it's opening an area of reporting regarding the effectiveness in terms of environmental sustainability of our expenditures, much more than in the past. It's an incredible incentive to be more transparent on these areas, and transparency is costly, believe me. So we're struggling to get information to our colleagues from our ministries. It's a very interesting activity, but it's tiresome somehow.
You mean the Ministry of Transport doesn't answer your email
because
straight away?
there's not even a culture regarding, I mean, of course, we have to account for all the expenditures that we do. We have fully clear, complete reports regarding what we spent and so on. But sometimes the efficacy of these expenditures, especially when it comes to environmental sustainability, is not so evident. And so we are pushing our colleagues to go in that direction. So it has a lot of, positive externalities, which I think, as I said, they're costly in terms of additional activity, especially for us, which was not our main job as a DMO. But I really believe this is something that we have to push through and go ahead. Having said that, however, when it comes to these specialized kind of bonds, I want to say we have, at least from a pure debt management perspective, I don't want to enter into kind of political decisions, because also the decision of green bond in Italy was also a political decision. But let me tell you that if I look at our public expenditure every year, we spend in current expenditures in the area of 850, 900 billion per year. And more than half of that is a social expenditures, different types, and we're not enter into this. So our standard bonds, like the BTPs, in some sense, they are social bonds because they are financing most of these kind of activities. So shall I now go into an idea of creating a social BTP or kind of digital BTP that we're mentioning and so forth? I don't know. I mean, this is something that would probably create some segmentation in the market. We are a big debt, so a lot of liquidity, that there would be a particular problem. But in general, I'm not completely convinced that we have to start issuing so many type of bonds depending on the type of expenditures, because this, from a pure debt management perspective, can really may bring some impact on the functioning of the market. When it comes to your question, and I'll stop, whether I personally am pretty convinced that in these discussions regarding reshaping the fiscal rules, rewriting, sorry, the fiscal rules in Europe. Of course, we should decline sustainability in a new way somehow, and take into account how much you'll be spending for environmental sustainability, for digitalization, should make a difference when it comes to calculation of data on deficit and debt. I think this is an ongoing discussion at European level. I'm confident that we'll sort out something new, important, and reliable on that ground. So in general, as a philosophy, I would say, I would answer yes to your question, but of course, then as in many cases, the devil is in the details, because then how you're gonna select an expenditure based on the fact that it's sustainable or not is not straightforward. So we need to have, of course, very clear rules, because again, moral hazard is always behind the corner, so we have to be very careful. But the principle finds me totally in agreement.
All right, good. I was just, my eye wandering to the audience questions. We must turn to those before too long. Bryn, yeah, please go ahead.
Just say something. I would disagree with Italy not being able to issue a social bond. They spend 16 billion euros a year on defence, and they are one of 5 of the North Atlantic Treaty, which hosts 40 B-61 nuclear bombs. We can't fund weapons war. We can't fund nuclear power. There are lots of things that we can't fund that the governments fund. And it's a very, I'm not picking on Italy, it's very much true for the UK as well. So we don't invest in gilts because they don't fulfill our green credentials. So I would argue that they would need to.
Yeah, well, let's hope that the nuclear bombs are not needed very soon, although perhaps more likely today than a year ago.
Can I reply 1 second?
By all means, do.
You know,
I do want to hear from Dimitris, but by all means, do.
No. My point, as I was saying, is purely from a debt management perspective, I was saying. So classifying so many different types of bonds and segmenting the market, I don't think it's in general something that makes market function very well. That was my perspective when I was mentioning this point. Specifically then, I understand our colleague point, but I think that is going to become then pretty difficult to decide which kind of expenditure should be included or be excluded. I don't know where we're going to end up, to be honest. I think it's more a kind of political decisions to decide where to put public expenditures, and more than being incentivized by the market. But this is my pure personal view. Okay,
Dimitris, we'll speed up the answer a little bit. I'm sorry to come to you last, but Greece's view on green and social.
Yes, we have just appointed a bank, one of our primary dealers, to play this role of, to undertake this role of structuring advisor. Yes, our plan is to have the final draft of this framework by the end of the first semester of 2022. And based on the plan that I just mentioned, most probably by the end of this year or early beginning next year, we will be in a position to issue our first bond, green bond. Initially, we are concentrated on green rather than on social, etc. But I need to stress what are the problems for Greece regarding the green funding activity. Since we are a small issuer, as I pointed out, initially, although we are familiar with this green project since I don't remember 2017, if I remember correctly. Initially, we were reluctant to proceed by issuing green or to be involved in this green funding activity because of the reason that I just mentioned. We were and we are small issuers, and by issuing green, we're going to create fragmentations, or at least this was the reason at that point of time, in our yield curve and in our efforts to rebuild the yield curve. You may imagine that if you don't have not even a conventional yield curve, how can you create a green one? But since at that point of time, it seemed that investors would prefer to have a fully established green yield curve. So this wasn't the case for us. Now, since we have realized that investors have, let's say, accepted a green bond to be incorporated within the spectrum of a conventional yield curve, now, yes, indeed, we will be in a position to issue a green bond in order to complete, if you like, complementary to the funding activity that we have in place, perhaps by issuing a node maturity for the reason that I've just mentioned before. The reasons for Greece to proceed and to proceed with this project are three. Not mainly the cost of funding, which is a very important one. Mainly is the brand name of Greece. We need to check another box in our to-do list. The second has to do with the expansion of the investors base, which is very important for us. You may understand, since we are BB, BB plus, BB minus, doesn't matter, but not investment grade, not at investment grade. We need to expand our investors base. I'm not saying that an investor would buy our bonds because we are going to issue in green. I'm pretty confident that they are going to take a look on the credit and thereafter on the green project. But in any case, we need to expand our investors base. And last but not least was the reason that I mentioned before, the reduction, if possible, for a couple of basis points, let's say, of the overall funding cost. What is the difficulty for us? It looks like a little bit peculiar, but let me make a reference on it.
Briefly, if you would, Dimitris.
Briefly, yes. We have plenty of funds to be absorbed by Greece. We have 27 billion EU structural funds coming in the next 7 years to be absorbed. We have 30 billion NGU funds to be absorbed in the next 3, 4, 6 years. So the challenge here is to be in a position to issue a green bond for green projects without, let's say, double up or double counting the funding procedure. Thank you very much. Sorry for
no, a very full and interesting answer, and technical as well. Thank you, Dimitris. So I want to move on to we got questions from the audience too, but I want to move on to this question of the NGU. NGU, of course, has been mentioned 3 times. The debates last year or statements last year that this was the moment Europe became sovereign in debt market terms, which is an interesting point of view and may well turn out to be the case. But just to quote from the Commission's own website, it's a temporary instrument designed to boost the recovery. And part of that recovery is more digitalisation, which of course could come in 1,000 different forms. But how are you viewing the NGEU project, not only from a rating point of view, but partly from a rating point of view, and how does it affect your view of the sovereigns that make it up? Tell us a bit about that, and then we'll go around quickly with everybody on NGEU, and then turn to an audience question or two.
Sure, thanks. I mean, as I said before, it's something that represents for the large recipient countries, a huge opportunity to address some investment gaps, some of the structural sources of weaker growth. And so, the key point for us is watching to see the extent to which countries are able to make the most of those opportunities. The other thing I would say is that you can't necessarily neatly separate some of the structural reforms and some of the investments, because as someone who's read many of these plans that countries have put together, there is often a mutually reinforcing aspect to them. And you mentioned digitalization. One of the things, and a number of countries are doing this, investing in digitalization and things like trying to improve the efficiency of public administration. There are obvious synergies that go between that kind of reform initiative and that and that investment expenditure. And like I say, ultimately, this can be one of the things that can boost growth. We haven't incorporated any of the structural reforms in the impact assessments that we've made on growth. We've really looked at what the impact could be if the investment funds are completely spent, and for the big recipients in Southern Europe, to give you a sense of order of magnitude. For Spain, Italy, Greece, and Portugal, we're talking about, say, 0.7 percentage points on growth. So it's meaningful. And there's potential upside there if structural reform actually comes through. But, as we said earlier, that's one of the question marks, and time will tell.
Yeah, well, time will, as always, tell. Elvira, I'm sorry always to be asking you the kind of conceptual question, but comment on NGU, of course. But I'm just intrigued to know, I mean, how can financial instruments really drive digitalization in an economy? Clearly, they can raise funds for governments who can then do things like, as Sarah said, make the delivery of government services or payment of social security, things like that, more efficient or more controlled, more visible. But how can they drive digitalization on Main Street, let's call it?
Sorry, wrong button. So 2 questions, if I'm correct. So first on the NGEU, yeah, we are meeting with them regularly. So Gert-Jan and his team, we see them regularly in meetings that we have amongst DMOs. Gert-Jan also mentioned it this morning. One of them is the ESDM, where we try to coordinate and work together. We were very happy that we saw their funding plan coming out by the end of last year, where they are more concrete about the planning for the next 6 months, when they will come out with syndicates and bills and auctions. So, and we've been stressing very much so that will be helpful to avoid traffic jams or conflicting days and auctions coming out. But, you know, we've also commended them big time, because what they've been doing in such a short time, setting up this organization, behaving like a DMO, raising such a lot of money. Of course, there's high demands, of course, for the products coming out. But you know, for them setting it up, it was a marvelous job. Your second question in terms of you know, can this money drive digitalization? And maybe if I interpret it more broader, can it stimulate or initiate other types of reforms that is needed? Maybe it's a push, maybe it's a motivation, but I think it's a political decision to make by the end of the day. I know, you know, from my country that we will make use of the NGU grants window, not so much the loan window, because we have more favorable conditions ourselves. But coming out of the grant window, we have 6 billion there, and the Commission was very clear that we need to hand in some very serious reforms. On the housing markets, on the pension side, on the labor market. So I'm not saying that that's the only drive, but I think, you know, having these requirements in that countries need also to make serious work in terms of making the economy more robust, have the earning capacity going up by implementing some kind of reforms. I think it's helpful, but by the end of the day, the governments need to make their planning by themselves.
Sure. Okay. Davide, NGEU, and perhaps in your case, a particular comment on the loans portion, which you touched on earlier on.
But I really cannot agree more with what Sarah was saying before. It's a dramatic and unique occasion, once in a lifetime, to address some of the issues that I'm talking for my country, but I don't think it's only the question for Italy, regarding some structural reforms and in general some other type of reforms that have been waiting for a while. So the incentive for us is strong, because differently, of course, from Elvira, we have clearly an advantage in terms of cost with these loans, and that is why we decided to go for the entire package of loan that was available. So there's a huge incentives there to have the availability of this money to push through all these investment projects that need to be accompanied with these set of reforms. So in our case, I think that the incentive is strong, and so the financial side of the story is not the whole thing, but definitely has a pretty decent role in going in that direction, because we have seen in the past that also investment in a lack of strong external incentives in Italy have been going down, public investment I mentioned. So now there is this incentive, so it's important. The last thing I want to emphasize is also the governance around the NGO issuance. So the fact that they will get this money based on a very tight control and report on targets and milestones, which is not completely aligned with what used to be for the EU structural funds. So this is a very important point that could really represent a game changer if we compared with our experience, the Italian experience with the EU funds that in the past has not been so brilliant. So
Okay.
these are all aspects that really should make the difference.
Davide, if you excuse me just for 1 second. Bryn, have you really got to leave? Can I ask you one last question?
Go on, one question I've got.
Okay, one last question.
CEO,
the NGEU is temporary and it is a path to normalization. A, is it temporary? And B, is it a path to something? And how will we know when we get there?
I don't think it is temporary, because temporary, well, these things is, how long is temporary? You know, temporary 1 week, is it 6 years?
Will it still be here in 50 years?
That I don't know. God, that's really crystal ball stuff. I suspect in what I would say is temporary in a lifespan of someone's career, it probably is not temporary. I would expect it to be there for a while. Is it a path to normalization? What is normal right now? So a new normal, maybe.
Okay, well, what is it a path to, insofar as it is a path and it indicates a direction of travel? What is that direction, or what is the destination?
Well, like I say, I think we're still in a world of social capitalism. I mean, it really comes down to philosophy, right? So, you know, economic philosophy. Where are we going to be in 25 years' time? I think we're going to be more socially linked into each other. If you go back into my big thesis of the Anthropocene, that there's more people on the planet. We're doing, you know, it's in a period now where we're having a bigger impact on the environment than the environment's having on us. And in that environment, our economics and whatnot, where do we put all if we're going to make people live for 100 years, where are we going to put them all? Where are we going to put all the key workers? That was indicated by coronavirus. It's not going to be the last pandemic that hits the planet. You know, as we get rid of biodiversity, there was a bankrolling extinction came out just before the pandemic, and in it they said if you destroy the environment, you create the perfect conditions in which pandemics can thrive, because the animals get closer to us and they pass more diseases to us. So, you know, big philosophy, I would say it's here to stay. We are now becoming more socially linked. You know, the EU itself is trying to become a nation state. I wrote a dissertation about this when Russia was breaking up and coming into smaller states. At the same time, the EU got together. You know, so I do think we're in a much. I don't think it's going away. That's
okay. Well, I'll certainly put my hand up to moderate and take part in a philosophical panel with you. Let's hope OMFIF would like to do one, and I'm sure our representatives from the land of Erasmus and the great Greek and Roman philosophers would agree. I can't think of a great American philosopher, Sarah, but I've no doubt there are many. Okay, thanks, Bryn. Davide, I'm going to turn to you because there is an audience question waiting our attention. And we've got 12 minutes left. I'm not sure quite how I turn on our question. He's one of your countrymen, so you ought to hear from him. Matteo Ferrario I think he's the head of fixed income at Mitsubishi. Matteo, can we hear you or see you conceivably? Question about NGEU.
I don't know whether you can see me, but hopefully you can hear me.
We can certainly hear you. Far away.
Well, Davide, congratulations on your 30 years syndication, and really nice to reconnect. And we've seen Japanese and more generally Asian investors that have shown a lot of interest on NGEU issuance. They've been selling US assets, buying Europe for diversification. And because NGEU trades at a premium to bonds and Treasury, the two questions really are, have you seen a similar trend in BTPs from Asian investors? And secondly, if yes, do you expect this trend to grow when, as Gert Jan said, liquidity should improve and spread should tighten in European issuance programs?
Can I jump in?
Please go ahead.
Okay.
Yeah,
Okay.
yeah,
no, first of all, ciao Matteo, it's a pleasure hear from you. Sorry for this private parenthesis. Yeah, we have seen some trend definitely last year of Asian investors, and in particular Japanese investors, especially some Japanese pension funds, start building some buying program in our market. They've been doing this in the past more episodically. It seems now this is more structural, even if not in large size, at least so far. Of course, right now there are many other things evolving in Italy. As you know, there is this issue regarding presidential elections, so this may create a little bit of wait-and-see strategy for several investors, including them. But definitely we have seen something changes last year, I can confirm this. On the EU issuance, I'm not surprised. We've always been very much in favor of having these European bonds, and we were sure that it would be a tremendous catalyst for the euro as a currency. But the only thing that probably need to be further improved is definitely the liquidity on the instruments, and so we've been also working and liaising with our colleague at the Commission in order to boost the liquidity in the secondary market and try to have more structured and monitoring trading activity. But this is something that is still evolving, and we're confident that they will definitely be more liquid in the coming future.
Okay, thanks, Rory. Thanks, Matteo. Sarah, the next question was actually specifically addressed at Bryn. Would you buy these bonds? But I'm going to ask you, because you also have an overview, and you're not. OMFIF has really got to get bigger type, because I can't sit with my glasses on or with my glasses off. So excuse me as I lean forward. Sarah, I'm asking you this, if Italy or Greece or the Netherlands were to issue not a green bond, but general purpose bonds linked to a KPI measurable sustainability project, the success of which would entitle the issuer to a rebate of what would otherwise be a higher coupon, well, would you invest? But what do you think of that idea?
I'm a rating analyst. I can't invest in anything.
No, I know. Well, you presumably have a 401k, I'm sure. But what is your view of the investability of such an instrument as opposed to a green bond, so-called?
Yeah, I don't think we've taken a view on the investability of an instrument like that. I mean, ultimately, and this goes back to something that Davide was talking about from the sovereign rating perspective. I mean, debt is debt. I mean, where we see a credit implication of some of these projects, and this comes back to some of the Next Gen EU themes as well, is what do some of these investments mean for the economic strength of a country? For example, how does it help to build resilience? You have, generally speaking, in Europe, the levels of resilience to climate-related events or carbon transition is they're much more resilient than countries that we see elsewhere in the world. But to your question about digitalization, for example, this isn't something that happens overnight, but some of the large recipient countries are also some of the countries that according to surveys that are done by Eurostat and the Commission, also have relatively low levels of digital capability, which is something that is certainly a constraint on future productivity growth. It's also a constraint on future employment for many parts of the labor force. And so, I think that for us, what matters as a rating agency is really how do any of these investments then have a knock-on effect on things like productivity and growth potential or employment in the economy, because that also can have an impact on things like political risk.
Sure. Elvira, very quickly, I mean, such a kind of coupon step down on a KPI linked instrument, you're not buying that? I have to say, this question comes from a lawyer.
Yeah, I know what he was.
Partners out in Ovary. They'd obviously make a lot of money.
So I think the green bonds is now a nice way of, as I said before, broadening the space. It has accepted standards, it has accepted criteria, although the EU taxonomy is putting us in a different ballpark. It makes it much more, we need to be much more explicit about the impacts, and that's fine. We need to raise the bar there. I would have doubts on this applicability of sustainability-linked bonds being issued by governments. And also social bonds is hard. As Davide said, you could sort of make it very easy, say the whole budget of the Ministry of Social Affairs is being allocated to social bonds. But the markets have been very clear to me that they would not accept that because that's sort of too easy. You need to make it a very dedicated bond, for example, for a unserved part of population, that you have some special programs. It needs to be distinguished, and you cannot so easily say, well, my whole social affairs budget is being linked to the social bond. For a government, a sovereign, the bar is pretty high. You have to be very explicit on what you mean. And on sustainability-linked bonds, what the difficulty there is that governments don't like unpredictability in interest payments. So if you have a step up or a step down in coupons, governments don't like that. They like predictability interest payments. So I think these bonds are very nice for corporates because it concerns their project. They have an influence on this project. I think for government, sustainability-linked bonds is really hard. I would not consider it.
Okay. Well, Yanis, thank you very much for your question, but not many buyers here, I'm afraid. We have technically 5 minutes left. Marcin or Ben, if somebody could tell me if we're allowed to continue over the 5 minutes, because there are 2 or 3 other questions that we haven't touched upon. And one that I'd like to hear panelists' views on, kind of thing that DMOs always say I couldn't possibly talk about, but at least we've got somebody here who isn't a DMO. I mean, it came up obviously in the opening session with Mr. Koopman and David, and will come up in every conversation. It's my question number 10, where I said not for the first time the ECB and the Federal Reserve seem to be playing from different playbooks. And how do markets view that? Because I mean, monetary policy divergence, as Brian said in the last panel, inevitably in the end causes market distortions and may give rise to policy shifts. So, I mean, does anybody want to address that from among the DMOs? I'd be delighted if you did. They're all looking the other way. Sarah, what do you think? I mean, it is a question.
I mean, ultimately, our view on interest rate policy in advanced economies is that we think it really comes down to how well inflation expectations are anchored. Our view has been in Europe that we see inflationary pressures as being transitory, but I mean, how long is transitory? Ultimately, if you're talking about the Fed, if you're talking about the ECB, you're talking about central banks with a great deal of institutional credibility that have done a good job at anchoring long-term inflation expectations. And fundamentally, that is our expectation of their reaction function, is that if they see there being that this anchoring is becoming dislodged, then our expectation is that they would act. I would also say, though, that the economic dynamics in the United States and in Europe are also quite different with regard to things like how the labor markets work, the nature of the kind of support that was provided during the pandemic, the nature of the kind of support that's being provided to economies coming out in the recovery as well.
Okay, sure. I mean, does any of our DMOs want to dip his toe in that water? Elvira's already said no, so it's Dimitrios or Davide. No, I'm not sensing a huge pickup on that. If you guys have a couple more minutes, I do want to ask you the questions that we sort of telegraphed earlier on. Sarah, I know you've got to drop off shortly, but Davide, can I ask you very quickly? You had a very notable return to the dollar market. Italy had a notable return to the dollar market the back end of 2019, and you've done a couple of other trends. I think you've done 3 dollar benchmarks, haven't you? What's your view on that for this year? Obviously, it leads somewhat from the question I was just asking, but what is your view on that?
Well, as we always said since 2019, our return to the dollar market is a structural return. It's not something opportunistic. So will keep on being present in this market, as of course this divergence in monetary policies stance can create some interesting evolution on the FX, and of course having these program in place, these may add, you know, for new opportunities for us also in terms of not just only in terms of cost. Of course, we look at cost compared. Of course, we spot back these bonds into euro, and we compared with the cost of our domestic bonds. And but I would say that we don't need to have a perfect arbitrage versus our domestic bonds. But the other reason why we issue this bond is incredible opportunity of diversification of investors, especially in our long end bonds, dollar bonds. We have seen a lot of Asian investors that normally don't buy our domestic paper, and these are really strong buy and hold investors, and for us it's definitely an opportunity that will keep on exploiting even this year, probably by launching also new benchmarks. But as you have seen last year, we also go through a reopening of the existing bond, which is not a true common practice in the dollar market, but it worked pretty well. So we're now open to both opportunities, so reopening bonds or launching a new benchmark in order to have a even more complete curve now.
Okay, very good. Elvira, Dimitris, do you have 5 minutes left? Can we continue? I'm going to send to you last, Dimitris, because your bond is literally hot off the press yesterday, so we want to hear exactly how that transaction played out. But Elvira, I had one question for you, as you know, whether you want to answer this one or another one I can come up with, but the Kingdom of the Netherlands does not issue inflation-linked debt. Are you considering it, given the current environment? And if you aren't, why aren't you?
Why aren't you? Yeah, as I said early on in the panel discussion, we have until the pandemic been a relatively small issuer. So we have to be very critical on issuing new products. Up until pre-pandemic, up until now, we haven't seen a tremendous demand in the market for inflation-linked bonds coming from the Dutch state, to be honest. And I think specifically for this type of bond, you really need to have a liquid curve with various maturities. You really need to maintain that. And our funding needs up until now have just not allowed us to do so. So we haven't heard it, we haven't seen that the market has been vocal about it. In contrary, for example, years ago, when the market did ask about green bonds, we haven't heard the signal on inflation-linked bonds yet. We always consider whether there's a need to include new products. We will continue to do so, but it's not on our agenda for this year yet.
Okay, good. Thank you very much. And finally, I am going to come around, Dimitris, to you and your success in the market yesterday. Well, tell us whether it was a success or not. You settled on 3 billion euros in the end. I think it's a 10-year benchmark deal. How did it go? The demand, different reports from the demand. One report says 5 times oversubscribed, but one of the panelists in the last panel said, for some technical reason, I'm afraid I didn't quite understand, that the demand was lower than that. So tell us what you did yesterday, Dimitris. You probably got up very early, apart from anything else.
Oh, thank you very much for the opportunity. Given the circumstances, yesterday's deal should be considered as a successful one. Indeed, the overall order book was about 15 billion, 5 times the issued amount. It wasn't an inflated one, I need to stress. We have avoided since 2019, or 19, yes, when we came back to the capital markets to inflate the order books, and to be honest, and since this is a big boys discussion, in order to avoid creating illusions to our political supervisors. That's why. This is the main reason. We want to be stick on ground, let's say, on the ground. We need to live the real life, not the virtual one. So it was, if you allow me to say, a not inflated order book. Just to give you a concrete proof, the orders, the overall orders of domestic investors, if I remember correctly, didn't exceed the 2 billion. So you may understand, if you want to inflate your order book, you can put a couple of your banks, let's say, just to put orders. We left on the table a new issue premium that could be considered slightly higher than a decent one. Why? Because we respect investors. We want to compensate investors at that volatile environment, investing in an asset that, for the time being at least, does not belong in the so-called investment grade environment or group. Last but not least, there wasn't any need to issue anything. As I mentioned initially in our discussion, as we speak right now, we have 40.7 billion cash reserves, sufficient amount to cover our gross financing needs for the next 3 or even 4 years. Why we issued? Because we want to keep our continuous presence to the capital markets. We want to continue the dialogue with investors. We want to facilitate the secondary markets operation, providing additional liquidity. 3 months ago, we were inside Italy, across the yield curve, between 15 and 50 basis points. Do I buy this argument? No, is the answer. Italy can raise in a blink of an eye 10 billion, the overall issued amount of Greece in 1 year. So give me a break. They are a mature market. We are trying to reach investment grade still. We deserve, but we are not the competent authority to provide us the investment grade. Now, indeed, we left on the table a decent, according to our thoughts, new issue premium. I think that investors were compensated accordingly. As far as I can see now on Bloomberg screens, the secondary market performance is pretty stable. So yes, given the circumstances, the yesterday's deal was a successful one, and we provided an additional liquid point benchmark GGB across the maturity spectrum of our yield curve.
Well done. Dimitris, you and I have known each other slightly since somewhere near the beginning of the century. We can always rely on you for a big boy discussion. That's very good. Thank you very much. It's a good point to end on. Davide, Elvira, Sarah, Bryn in absentia, thank you all very, very much for taking part in this discussion. I hope all of you found it interesting, and I know people in the audience found it interesting. I'm sorry, people of the audience, if I didn't get to every question. My apologies for that. As I hope you all know, OMFIF has new content every day covering debt markets and things like the digitalisation debates, and Digital Monetary Institute, which covers central bank digital currencies and so forth, many other things besides. There's always some new content, so do have a look. And of course, there are regular sessions like this. I think the next one under the SDI that I might be doing will be on emerging markets. But look for the calendar. Thank you all very much once again. Lovely to see you all. And Happy New Year, if it isn't too late to say that. It certainly feels a little bit better than it did a year ago, as long as the one big thing doesn't happen that we fear might happen. So, ladies and gentlemen, thank you very much, and goodbye to all of you out there. Bye-bye.
Thank you.